So I started struggling a lot less with day trading and started to have a high probability of winning once I finally learned how to choose the right stocks to day trade. In today's video, I'm going to show you guys how to choose the right stocks to day trade by teaching you how to read certain parts of option contracts and also teaching you how to do pre-market analysis. So I value your time. With that being said, let's get right into it. All right, so now we're going to compare two different option contracts, and I'm going to show you guys some things that you need to pay attention to, especially if you're a beginner trader. Let's get into it. All right, so on my screen right now, I have two different option contracts. One is for DPZ, which is Domino's Pizza, and then the other one's for SPY, SPY. So currently right now, the broker that I'm using is Robinhood. It doesn't matter what brokerage or broker you use, it's going to be the same metrics that you're going to see across all platforms. So I'm not going to break down every single little detail that you see right now on my screen for an option contract, but you shouldn't be trading option contracts if you don't understand every single thing that you see on my screen right now. But from a day trading perspective, the two most important things that you really want to pay attention to is something called your bid ask and something called volume and open interest. So what is your bid ask? So your bid is basically telling you the highest price a buyer is willing to pay for a contract, and your ask is basically telling you the lowest price a seller is willing to sell for your contract. Your volume is just basically telling you how many of those contracts were, sold or open throughout the day. And the open interest is telling you how many of those contracts are currently open as of right now. So this is very important because let's say, for example, you're a beginner day trader, right? And you think Domino's Pizza is going to have a really good day and you want to day trade Domino's Pizza. So this specific contract that I'm showing you right now costs $11.90. So you multiply that by 100 because an option contract is going to give you 100 times the original share that you're trying to buy. So this option contract is actually going to cost $1,190. So let's say you buy this trade for $1,190, right? And all of a sudden you regret the trade. So now you want to get out as fast as possible. Let's say the contract hasn't moved at all. The stock price hasn't really moved at all, right? And you do a market order to get out as fast as possible. Whenever you do that market order, more than likely it's going to be filled around this $930 price because this is the highest price that a buyer is willing to pay for that contract. So off the rip, you just lost almost $200 just by simply buying and selling. So now, if we go to SPY contract, you guys can see the big difference. SPY has a really tight bid ask, right? So this is roughly about a 15-point difference, something like that, right? So it's way tighter than the other contract. And you can see how the volume is significantly higher, open interest is significantly higher. So this plays a big part and how your bid ask and how wide the bid ask spread is going to be. So for example, with SPY, if you decided that you wanted to day trade SPY and you bought this contract for $498, which is actually going to be $498, right? And you decided that, okay, you wanted to sell as fast as possible, get out the trade, and you did a market order, you would get filled around this $483 price, right? And only lose like $15. So that's a big difference between losing $15 versus losing almost $200 just like that. And this is simply you just buying or selling. This isn't accounting for the trade not going your way and you lose more money, right? Because the trade didn't go in the direction that you anticipated for it to go. All right, so I hope that makes sense to y'all. Basically, my point is this is why people typically day trade your ETFs like SPY, QQQ, IWM, or your Mag 7 companies because they have a lot of liquidity and the bid-ask spread is extremely tight. So it makes it super easy for you to easily get in and out of trade. And when you're day trading, you want to make sure you have a really good spread so you don't unnecessarily lose money just by buying and selling. So if you're a new day trader and you want to day trade something typically out of those norms, like your ETFs and your Mag 7 companies, you need to be able to understand and look at the bid-ask spread and also look at the open interest and the volume so that you won't necessarily lose money. So with that being said, let's now talk about the most important thing, which is learning how to do pre-market analysis. Let's get into it. All right, so currently right now, I'm still on the Robinhood trading platform, but basically what you can do now is create a watch list based on the knowledge that I just taught you, right? You want to day trade stocks that have a lot of volume and open interest and a very tight bid-ask spread, right? So on the left side of my screen, this is just my general watch list of stocks that I'm paying attention to, right? I may want to swing trade, buy leaps on, or just buy the individual asset itself. In the middle, these are stocks that I typically want to day trade because they have a lot of liquidity, right? Really tight bid-ask spread. And, a lot of open interest and volume. And then, of course, I have my indices, right? My ETFs that I typically would day trade to because they have a lot of volume. So that's what you want to do. Create some type of watch list of stocks that, you may have some type of interest in day trading. And whether you trade one stock a day, right? Maybe you just decide to trade QQQ only or SPY only, or you want to trade 2 stocks, 3 stocks, 4 stocks, 5. It really doesn't matter as long as you have a defined strategy. So me personally, I trade 8 stocks a day, right? I watch 8 stocks a day. So this may be too much for a lot of people, and that's fine, right? Maybe you only want to do 1, maybe you only want to do 2, 3. It doesn't really matter, but I'm comfortable with 8. So let me teach you though, if you want to do significantly less, and let's say just focus on 1 or 2 stocks per day, which is completely fine. Let me teach you how to determine which stocks could have the higher probability of you finding a really good trade. So for this example, I am going to use Palantir stock as an example. So what you want to do whenever you're doing pre-market analysis on a stock that you want to day trade, you want to look at the higher time frames. So right now I'm on the 1 hour time frame. So you could do the 30-minute time frame. You can do the 15-minute, even the 4 hour potentially, right? But you want to do something higher than like the 1 or 5 minute, because you want to get, a better idea of what the trend is actually doing. And you can do this by looking at those higher time frames. So on my screen right now, I have the indicators that I use to help me determine if a stock is trending. I have the EMAs. So I have the 9 EMA, the 21 EMA, and the 50 EMA. So what I'm basically looking are for 2 different conditions, right? There's a condition where you want to trade and a condition where you don't want to trade, right? And the conditions where you want to trade is when a stock is trending, right? Either trending upwards on the higher time frame or trending downwards. Condition where you don't want to trade is when a stock is extremely choppy on the higher time frames, because in trade day, the stock can typically mimic those higher time frames and be really choppy, right? And those are bad market conditions for you to trade in when you're day trading. So let me show you what I'm talking about. So for Palantir, let's look at the past couple of days over here. If I'm doing pre-market analysis, once again, I'm in central time frame, so the stock market opens up at 8:30 for me. So I may come do pre-market analysis like at 8 o'clock or 7:45, right? Or you could do it the night before. It really doesn't matter. But basically, let's say I wanted to day trade Palantir stock. I'm looking at the higher time frame, once again, on the 1 hour. And how I know that a stock is choppy or a stock is actually trending is I look for good separation on the EMAs. I'm looking for price to just essentially ride the 9 EMA or the 21 EMA, and where it doesn't cross over between all the EMAs, right? So let me show you what I mean by this. If we look at Palantir the past couple of days, just looking at this stock, you can tell that it's just been choppy. It's literally just going up and down, right? You see it crossing over the 9, the 21, and the 50 EMA crossing back down. It's extremely choppy conditions. And this is typically something you want to avoid. The reason why I say this is because when a stock is choppy on the higher time frames, whenever you go in trade day, it typically mimics that performance, right? So for example, let's say you decide to day trade Palantir, right? Coming into this day, we had this big drop, the stock opened up, right? Had some good momentum up, eventually crashed back down, right? Really choppy conditions. So not saying that you couldn't find a trade here, right? But it's a game of probabilities, right? You're going to have a higher probability of finding a good trade when a stock is trading well on the higher time frame. But overall, it's just really choppy, right? You go into the next day, a lot of just choppy price action. And when price action is just choppy, you can have a lot of fake outs, right? So your strategy may not work as well. You have these big reversals that just, stop you out. You come back here to the most recent day, the same thing, just choppy price action. They had this big drop, then it reversed real quick. Just really choppy stuff. Once again, not saying that you cannot find a trade in conditions like this, but you may just have a higher probability of, not getting a good trade when the conditions are super choppy. So now let's look at an example of when the stock is trending and when you want to, potentially pick a stock to day trade. So if I come back here on Palantir throughout this time frame, you guys can see that if I was doing pre-market analysis and I saw this stock, I see good separation in the EMAs. There's a lot of space in between them. And you see how just the price is riding the 9 and the 21 EMA and basically just making higher lows. Just good market structure in the higher time frame. This is what you want to trade, right? Because in trade day, you can get really good continuations, and this is when you can catch really good trades and the stock can go extremely in your favor, right? So let's break down Palantir stock the past couple of days and show you guys what I'm talking about in this time frame. So coming into market open on this day, right? If you would have had your levels marked out, previous day high, previous day low, pre-market high, pre-market low, Palantir had this huge flush, right? Good separation of the EMAs over here, right? So this could have potentially been a really good trade. So maybe on a lower time frame, like the 1 minute, you could have had some type of retest on the previous day low for price to come down, then go back up, and then had a flush, which could have created a really good opportunity. Coming to the next day, you guys can see that good separation on the EMAs. Price is just riding that 9 EMA, right? The 9 and the 21 EMA. I have my levels marked out. Previous day low right here. Previous day high. Pre-market low. And you guys can see that you just get good continuation. This is why when the higher time frame aligns, you can catch some really, really good trades in trade day. It just increases your probability. It doesn't mean that it's always going to be a good trade, but it's just increased the likelihood of finding something good. All right, so this could have been another great trading opportunity. All right, we're coming to the next day. Have your levels marked out. You're watching this stock, right? So this day was kind of choppy a little bit, but overall the direction kept on going down. Because the higher time frame is in this huge downtrend, right? Stock is making higher lows on the higher time frame. You get good continuation throughout the day, right? The stock essentially just went down throughout this whole entire day. So going to the next day, this one had some chop, right? Eventually it did flush down. And then going to the last day, right? You mark out your key levels. The stock had this big flush, which created another good opportunity to trade, right? So I hope you guys see my point. My point is that when the higher time frames have a good trend, good separation between the EMAs, and price is just riding that 9 EMA and that 21 EMA, you can have really good continuation and follow through on your trades whenever you're day trading, versus trying to trade really choppy conditions like this. Not saying that you can't find a trade in these conditions, but you're going to get a lot of fake outs because the higher time frame is just extremely choppy, right? So you may not want to choose a stock that looks like this on the higher time frames. All right, so I hope that makes sense to y'all. So my point is that trading at the end of the day is just a game of probabilities, right? And you can increase your probability of things going your way when you choose the right stocks, right? Stocks that are trending well on the higher time frames, and stocks that have, a tight bid-ask spread with a lot of volume, make it easy for you to get in and out the trade. So I hope you guys learned something new. Hope you enjoyed the video. Make sure you like, comment, subscribe, and I'll see you guys in the next one.